to the first ever Multiply live Q&A. This is a very exciting moment for us, as first time we've done this. So we're going to do our best to answer all your questions, and if we have any technical issues, that's definitely my fault. So just quick introductions then. I'm going to be hosting and moderating today. My name's Annie. I am on the product team for Multiply. And with us today is Vivek, who is the CEO and one of the co-founders of Multiply. He had a 12-year career as a derivatives trader before coming across the world of financial advice about 5 years ago. So he's now a qualified financial advisor and a big advocate for the power of advice to improve people's lives, basically. For him, it's not just about finances, it's an emotional thing as well. And Peter is our head of advice at Multiply. He's been in the advice industry for 25 years now. He's done it all really, from advising his own clients one-on-one in the face-to-face traditional way, and he's worked in training, operations and more. So he's all about sharing knowledge to improve people's financial knowledge and to help them make the best decisions. So they will be tackling your questions today, so you are in good hands. So thank you very much for submitting your questions online. Ooh. Hang on. There we go. Sorry about that. So we're going to jump right in with a question that was submitted online. How do you achieve a yield on your investments without accepting unacceptable risk in this environment? So, Vivek, would you take this one for us, please?
Yeah, sure. Thanks, Annie, and thanks to for that initial question. I think it's a question that points to quite a common theme of questions we've been getting in. And really, to answer this question, we need to go back almost to the principles and the foundations around investing in the first place. It's, when people are investing and they're looking for a yield on their investments and returns on their investments, really the fundamental things to look for and to look at are making sure that you invest in a diversified way. You do that, you invest in a way that is low cost and tax efficient. And actually a really, really important point when you're investing is that the investments that you put your money into are in line with your attitude to risk. And your attitude to risk is essentially how much risk is acceptable. I mean, it's almost in the definition of, an acceptable amount of risk. So the most important part in terms of, achieving a yield without taking unacceptable risk is to make sure that the investments you do put your money into are in line with your attitude to risk. And to find out that attitude to risk, there are many different ways. In our app, we have, a set of questions that allow us to really ascertain what someone's attitude to risk is and what an acceptable level of risk would be. What do you reckon, Peter? Anything you'd add to that?
No, I think you've caught the main principles of it. The only other bit that I would just add, which is quite a key point as we go through this webinar, is the terminology that we use. So typically the word a yield on your investments. Now, a yield within the industry could mean just the total return that you get. In other words, the growth, shall we say, or more commonly, yield is often used as the income that an investment yields. So I'd just like to introduce that as we go through some of these questions. What we may well do is explain a little bit more about some of the terminology that's there before we answer the question. So, for example, an investment might be seen as something different to somebody's savings. So apart from that, no, great answer.
Okay, awesome. Thank you very much for that, guys. Just to say, if you have any questions as you're watching, if you haven't yet registered a question, if you have a new question, if you could add it to the live chat in the top right of your screen, then I will pick those up as we go and we'll try and get to them as many as we can. So, next question. This time I want to throw this to Peter first. What type of investment vehicle do you recommend for most people? Should I be looking at low-cost passive trackers or actively managed funds?
Wow. I think I better start with the definitions with this one. So what type of investment vehicle? Now, typically we would say savings as being bank building society account, something like a cash ISA, for example, whereas an investment would be more likely be deemed a longer term investment, say 5-7 years plus as being the objective, and therefore we tend to call those investments, and they are usually, but not always, will include what we call asset classes such as shares, bonds, which are typically loans, or indeed property in some form as well. So there's the investment definition that's going there. The next part, you mentioned low-cost passive trackers and actively managed funds. Well, I think to keep it as simple as we can, the low cost, I would like to think, is fairly evident what that means. But a passive tracker broadly means that it is something that tracks an index, and the passive part of that, so it's not always an index, it tracks something, shall we say, but the passive bit is that there isn't anybody making a tactical decision over whether to invest a little bit more in this part or a little bit less in that part. And the put together low-cost passive trackers basically means it's a cheap way of investing into something that tracks a market. Now, we could get into detail there because there are some people would argue that, well, you can invest into things that don't quite track, but let's assume that basic principle. Actively managed is almost the opposite of it, which is broadly where somebody, a fund manager usually, is actively trying to outperform the market, or should we say that index that might have been used. So that's typically how we would define actively managed. What type of investment vehicle do we recommend? Well, I think we come back to, first of all, we have to go back to, has somebody got some of the basic principles in place first? So, for example, has somebody got cleared any what we'd call bad debt or typically high interest debt first? We would then be looking that somebody has at least started to have built up their emergency fund for the what-ifs in life that come along. And if necessary, that they've thought about things, for example, putting in place protection for their family or for themselves, even if they were, for example, unable to work. And the current environment is a good example of that. So assuming those things are in place and people have saved for any shorter term goals that they might have, which typically we would recommend into cash-based building society type accounts, we then come into investments, which is the longer term investments. Low cost passives or actively managed? Well, there's lots of debate regarding whether one is better than the other. There's lots of evidence that shows that low cost passive trackers tend to outperform actively managed funds. But that's usually generally when things are seen as a whole. So, for example, a sector of investments as a whole. So when we look at low-cost passives, the one thing that I guess you can be fairly sure of is that you're not going to outperform the market, because that is the principle of what you're doing. You're saying you're happy to go with the market. Actively managed funds, in the past, I've recommended lots of actively managed funds. Although when you look back over the longer term, you'll often find that there will be periods of times when one particular fund manager does actually outperform the low-cost passive tracker fund, because the environment at that time happens to suit that particular fund manager and their style. Similarly, and quite often is the case, that the market changes in such a way that that fund manager is maybe not so in favour, and then he tends to underperform the low-cost passive tracker. So the question is, should I be looking at low-cost passive trackers or actively managed funds? Well, I guess some of this is going to come down to your risk appetite. So if, from what I've said so far, actively managed funds means that you have the chance to outperform the markets. So are you the type of investor that is prepared to take that risk? If you're not, then maybe a low-cost passive tracker fund is the better one. And it is worth noting here that the price difference between low-cost passives and actively managed funds can be quite significant. It can be typically 3 or even sometimes 4 times the amount of the tracker funds. So those actively managed funds have got to do pretty well just to keep up with the tracker fund over that time. So the shorter answer is, what would I recommend for most people? Well, one thing's for sure. We would typically always recommend funds, right? And what I mean by that is that's where your money is being pulled in with my money, that's being pulled in with Vivek's money and Annie's money, and it's all being put together, and one professional fund manager is making the decisions and benefiting from the buying power of lots of investors together. And that is one thing that we typically always will recommend. You won't find that many financial advisors who actually will say, oh, I think you should be investing into Lloyd shares, or I think you should be investing into AstraZeneca, for example. And by the way, they're not recommendations. But the key there is partly often they don't have the regulatory permission to be able to even give that type of advice. But the key thing is, you're better off pooling your money and letting a fund manager who's looking at this stuff on a day-to-day basis manage your money for you, right? Your low cost versus actively managed. Well, traditionally, Multiply, we've very much favoured the low cost passive tracker approach, although we have in more recent months been looking at the actively managed fund sector, and I guess there's an element of watch this space with that. But yeah, I'd like to say that one is better than the other. I can't. The only thing I can say is low cost passive trackers, you know you're going to get what the market does, but you're not going to beat it. Actively managed funds, take a bit more risk. You might beat the market, but you might not. Is there anything you wanted to add there, Vivek?
Yeah, I was just going to say that to me, I think you're seeing quite a lot of products and funds launched now which are almost in between. You know, there's a heavy component of them which are passive, but then there could be aspects of them that are a little bit more active, particularly when it comes to the multi-asset space, where there could be, you know, a couple of different core equity tracker holdings within a multi-asset fund, but then a little bit of kind of more actively managed components within it. But then also the overall allocation into each of those sub-funds is a little bit more active, in terms of like managing something to a particular attitude to risk, or a particular, you know, investment objective. So I think that the two are a bit more blurred. I think it's I think maybe, you know, 10 years ago it would be trackers or active. I think now there's kind of more of a blurred space in between. And in fact, some of the you know, options that we're probably going to be looking to recommend will be kind of probably in that category.
Yeah, exactly. And more and more advisors out there are using a split of saying, well, okay, I'm going to put 50-50 between the two. Or if you're more cautious, you might go, for example, 75% to the passives and 25% to actively managed. The more aggressive investor might be more actively managed. As long as they're understanding, though, that the actively managed fund managers don't always get it right. There's loads of, as I say, when you look at the sectors as a whole and compare the two, low-cost passive funds usually come out on top. Okay.
Cool. Thanks very much, guys. We've just had a new question come in from Anija, who says, hi there, I understand stocks, but could you please explain funds? What are those? So, Vivek, could you take that for us, please?
Yeah, you know, a really simple way of looking at what a fund is you know, a collection of, it's almost like a box where you can put in lots of stuff into it, and then with that box you can then split it back up and give units of it to lots of different people. So it's a way of pooling investments together, of lots of stocks, lots of bonds. It could be, you know, all manner of different things, and then allowing people to and slice it and have a slice of everything that's in that box, in a way. And that makes it way more efficient to invest. If you were to think of, one of our fundamental principles around investing is making sure that you're diversified. If you really wanted to get a huge amount of diversification and funds weren't around, you'd have to go in and, purchase lots of different stocks from lots of different countries, lots of different bonds and, properties and all that kind of stuff separately, rather than just buying, a unit in a single fund and just managing that one single unit of a fund. So it's a very convenient way of investing. And getting a lot of diversification and lots of cost savings from someone like going out and purchasing all these different sub investments on your behalf.
Yeah, if I could just add something there, is the bit for the investor to be aware of here is that there are lots of different types of funds. So, for example, you may have heard of investment trusts. Now, an investment trust is very similar to a unit trust, apart from the investment trust itself doesn't. So let me go back. The unit trust, its value is directly linked to the investments that it holds. So if the investments that it holds goes up, your value of your holding in that fund goes up as well. With an investment trust, there's an additional risk. And that is the demand of the trust itself starts to have an impact. So, for example, the same fund as the unit trust, which has just gone up in value, the unit trust, if it's invested in, the investment trust, if it's got invested into the same thing, should in theory have gone up. But if more people are selling that fund at that time, you might actually find that the value just drops or stays the same. So the reason I'm just explaining this is financial advisors, and certainly us at Multiply, will generally recommend what we call unit trusts or open-ended investment companies. That's the majority of the market and the advice that's given. And this is because it removes one of the supply and demand risks from the advice process itself. Okay.
Sweet. Thanks very much, guys. So our next question, which came in ahead of time, was: is it still a good time to transfer savings into a stocks and shares ISA right now, or would you advise to wait until the market is more stable? So Vivek, I'll throw this one to you.
Yeah, I'm going to answer this in the context of real principles and fundamentals around investing, which are that you should only really be doing it if you are looking to invest for the long term. Investing is very much a long-term activity, and by that we're looking at beyond 5 years in terms of horizon for people to invest. And the other big, really important principle is to make sure that any investments you select are aligned to your attitude to risk. And if you're doing those kind of things, then it almost takes the timing element of when to invest out of the equation to an extent, because you're really looking at doing it for 5 years, 10 years, 15 years into the future. And then, when you kind of get into it, makes, less of an impact over those wider kind of time horizons than if you were just looking to invest for a year or 6 months or something like that. In terms of there's a number of elements of this question which really tie into in particular the point around attitude to risk. So the bit around is it worth waiting until the market is more stable? The stability of the market is really something that ties directly to how comfortable someone is with investing and how comfortable they are around taking risk. Because if someone is very cautious, then that stability is really important. And actually, we work that into the recommendations that we make in terms of the investments for them to go into. We'd recommend more in terms of bonds than we would do in equities, and so that they would not suffer a huge deal of instability in their day-to-day kind of returns that they're seeing and observing in their investments. And then I think there's another really important point here, which is when it comes to investing, there's no one out there who has a crystal ball. You'll hear Peter and I say this all the time, and talk about this all the time, insofar as the market is very, very difficult to predict. There are tens of thousands of very talented people who are looking to try and predict the market day in, day out, and who just plainly can't do it, and find it very difficult to do. So the best thing to do is not to try and time the market, and to invest using these like real kind of important fundamentals and principles, and to do it continuously over time. Like right now we're still recommending those who have covered everything else in their plan. So stuff like the emergency plan, paying off any debts they need to pay off, life insurance, things like that. People who have money left over to invest, we're maintaining our recommendations for them to continue investing, because we think it's important to continue right now where there is less stability, and also at the moment where kind of markets have taken a bit of a downturn. Now it could be argued that now is a really good time to get involved and to kind of buy a lot of these stocks at a discount. So an argument could be made there. But I think the most important point to get across is to not look at investing as something that you're trying to time. To look at it as something that you're really looking to do over the long term, to build up your position in investments over a long period of time, and to hold them for a long period of time, and to do that in a way that's really aligned to how much risk you're comfortable taking.
And if I could just add a couple of points here, just directly relating to the question itself. One of it, the question said transfer savings into a stocks and shares ISA. I'd just like to reiterate at this point, a stocks and shares ISA is it's a bit like a wrapping paper that goes over a present. And the present is actually the investment itself. So, for example, that might be the unit trust that I mentioned before, or it might be an individual stock. Stocks and shares ISA is the wrapper that goes over it. So when we're answering this question, we're seeing this more as is it still a good idea to transfer savings into an investment, as in a long-term investment? The other bit that I did just want to mention was, because this mentions stocks and shares ISAs, if somebody was thinking of transferring savings from a cash ISA into a stocks and shares ISA, please don't do that yourself. If you go to the bank, take the money out of your cash ISA and then move it and put it across into another stocks and shares ISA, you'll have just lost the tax efficiency of the existing investment and used up your ISA allowance to put money in elsewhere. If you're transferring ISAs to ISAs, you would normally go to the new provider that you want to use and ask them to transfer the money, and you will sign a letter of authority that gives them permission to go and talk to your Nationwide, for example, to transfer the money over. Okay, and I would reiterate the benefit of the plan here, because since the pandemic, we have actually changed the amount that we recommend that people invest into stocks and shares at this moment in time, because of the very reason that Vivek just said about we don't know exactly what's going to happen with the market, but we're sort of recommending that maybe it's phased is the principle. So it's the benefit of the plan, and importantly, checking in regularly as well. Okay. Thanks, Annie.
Awesome. Thanks, Peter. That's really, really useful insight, both of you. Thank you so much. In a similar vein, we had a question now more on the home buying side. Obviously, a lot of our Multiply users are using the app to save up to buy their first home. So this is in that vein. Is now a good time to open another LISA? That's a lifetime ISA. So Peter, could I get you to take that one?
Yes, certainly. Again, I'm going to come back to definitions again. A LISA is basically a lifetime ISA, and it was introduced following the closure of what we called Help to Buy ISA. The Help to Buy ISA, as the name implies, was set up with a sole purpose of helping people save towards typically their first home for getting a deposit. They closed down the Help to Buy ISA with the objective of introducing it with a lifetime ISA, which, as the word again implies, it was seen more as a longer term ISA, but could also be used for the saving towards a deposit for a home, or any home that to that point. You've nearly reached your maximum to your LISA. Well, the good news about that is that the LISA allowance is repeated every year. You can put £4,000 into a LISA this tax year, and you can start it again next tax year. So you don't necessarily need to open another LISA. You can just continue, if you want, paying into your LISA. But you can't go over £4,000 in that one tax year. The relevance of the timing is now a good time to open another LISA. The answer again, I think, comes back down to what your objective is here and your affordability to keep on saving. What I would say to you is that putting money aside for the future rather than always spending it today is generally a sound principle. So I would say, is now a good time to open another LISA? Yeah, but you don't have to get a new one. You can just carry on paying into your existing one. Just don't exceed the £4,000. Hopefully that answers that.
Thanks very much, Peter. Vivek, do you have anything to add to that?
No, I don't. I think that response was very comprehensive. Awesome. Nothing to add on that.
Cool. So we've had another couple of questions in on the live chat. So we've got one from Rohit here who says, which is a good investment, do you think, at this time? Stocks or property? So, Vivek, could I throw this one to you?
Sure thing. I guess I'd kick off by saying, again, we don't really have a crystal ball, so we can't we can't predict what each of these different asset classes would be returning out into the future. And I think just doing that activity today is so much more difficult on the back of all this kind of economic uncertainty we're facing due to the pandemic. I think broadly, the way people are generally looking at the world is through trying to figure out, trying to lay out a number of different scenarios that could ensue, and looking to plan for each of those scenarios, and really they're, depending on kind of who you read and who you look to, they're often kind of letters attached to each of these scenarios, anything from like a V-shaped bounce to like an L-shaped recession to a W-shaped kind of recovery. There's lots of different ways of looking at the impact of the pandemic on the UK economy, and the impact on the economy will then filter down into what will happen to stocks, to bonds, to the property market, and so on and so forth. And it's just too early at the moment. It's too early to tell what kind of scenario we're likely to experience. The key drivers around them will be how much the virus is going to spread and the public health response, and whether or not we can find a vaccine. If we find a vaccine, then that will obviously be very positive news in coming through this. And I guess the other way to look at this is really in terms of the knock-on effects on the economy. Like, are we going to go for a multi-year lockdown with permanent damage to the economy, or are we going to kind of very rapidly bounce back to the way the economy was kind of humming along in kind of January and February? And I think those are the sorts of things to look through scenario-wise to then figure out what the knock-on effects will be in terms of the kind of investment markets, so stocks and bonds, or in terms of the property market. I think the only other thing I'd add to that is, this question was really framed in terms of what's a better investment. And when it comes to investing, we have the fundamental principles that drive how we advise people to invest. Investing is something that you do in the long term, so for 5 years and beyond. It's something that should always be very closely aligned and matched with how comfortable you are with investing and how comfortable you are with risk and how much investments move. And then finally, when you do invest, it's really important that you diversify. You invest in a way that's low cost and very tax efficient. There's definitely ways of doing that when it comes to the stock market and bond market. And to be honest, there's ways of doing that in the property market as well. So definitely, when you do come around to investing, do so in a way that follows those principles. Peter, what do you reckon?
In principle, I totally agree. I'm just going to actually use an example now. Now, Annie, can you just confirm that my father's not on the line? And the reason I say this, as you can imagine, over the last 25 years, he and I have had lots of discussions regarding savings and investments. And he was very much in the camp of, you've got to buy into property. It's a solid investment, blah, blah, blah. And the principle, what I'm trying to get across here is that there are plus points and negative points to everything. He bought into property. He had a tenant that was into his property, and this was an individual house that he bought. And he had 10 years of the same person living in there. He got a good rental yield out of it, and he was always harping on at me about how brilliant it was. And, I wasn't knocking it at all. Then that tenant unfortunately passed away, and then he had 5 years of nothing but problems with either tenants, stuff that needed to be done to the property, and then he got to the point where he decided he wanted to sell it. Now, selling it took him 18 months. And the point that I'm really trying to get here is that with property, if you buy into individual property, you have to accept the risks again, the risks that it might be hard to sell, the risk that you might have void periods where you haven't got people in your property. Stocks generally have the advantage that they are more liquid. They're easier to trade, okay? But sometimes the yields aren't necessarily as high. And I say yield in the basis of the income that can be generated from the investment. So again, I come back to what Vivek said, diversification is key. And I would just say to you that from a property perspective, you can invest into property through funds. Now, again, you do still have some of the liquidity challenges that goes with that, but it's just a different way of investing into property, which is more diversified. Sometimes, and usually it's into commercial markets as well. So just you have to accept there are plus points and negative points to both. Which are the risks that are right for you? The key bit I would say to you is try not to have too much of your investments as a whole in any one individual thing, whether that be an individual stock or whether it be an individual property. Thanks.
Thanks very much, Ruth. So a new question just come in live from Armin, who says, is there a general rule about proportioning regular savings versus long-term investments, i.e. accessible cash versus harder to access cash? 20% of monthly salary, split 50-50, that kind of thing. So, Peter, could I get you to take that one, please?
I think the short answer is no, there isn't a general rule. I think the key bit is regarding having the plan, which is it comes back down to making sure you've got your normal annual spending covered. And I say annual spending for a very specific reason. When people enter their monthly budgets into our app, you have to remember to take into account all of those annual spendings that come along. And I always use Christmas as a good example. I mean, people can spend hundreds on Christmas, and then when they come to assess their budget, they forget it because it's not one of those monthly things. You've got to include it and divide it up. So once you know you've got your expenditure covered, you've then building your savings for your emergency fund and your short-term goals, then you can invest. That's the broad, high-level principle, and there's a clearing debt and other bits in there. But the answer was, is there a general principle? And the answer is no, because it depends upon where you are on that journey. If you are early on in the journey and you've got debt that should be being cleared, that's where your money's going to be going. That's what we're going to recommend you do. If you're building your emergency fund, then it's going to be pretty much 100% into savings. If you've got your emergency fund built, you've got money and savings all for your shorter term goals all set up, then a greater percentage is going to be going towards longer term things. And your risk profile will determine where that goes. So unfortunately, there's not a sort of a rule that I can tell you other than that there are those basic principles that we follow. Anything to add, Vivek?
No, I'd say, you outlined a number of different uses there for people's savings or investments. For example, their emergency fund. I was just going to add, like, emergency fund, yes, it's savings, but it's really important that's instant access. And let's say someone has a goal out into the future. Let's say they want to buy their home in 4 years or 5 years' time. That's when you can start looking at putting your savings into maybe a 1 year or a 2 year product, because you have that visibility around how far out it's going to be going. That's just around, within savings, there's the whole instant access versus longer term kind of fixed savings products, which we also, include in our app.
Awesome. Thanks very much, guys. So back to another home buying related question. We had someone ask in advance, will it be harder to get a mortgage if I'm in the middle of home buying? So Vivek, could you take that one, please?
I think again, this really does depend on the kind of scenario that pans out for the UK economy and for the housing market. I guess the different aspects to play here are, first of all, when it comes to mortgages, really like what's going to be happening from the viewpoint of the lender. So what are banks going to be doing in response to the crisis? Are they going to be lending less? Are they going to be are they going to be reducing their kind of loan to value ratios? So they're going to be expecting higher levels of deposits. And are they going to be essentially more stringent in terms of their lending standards? And we just need to wait for that to pan out. So far, we can see there is some element of stress on banks' lending balance sheets. Whether or not that then gets translated through into the first time buyer market, mortgage market, is yet to be seen. I think that the flip side of this is really, what's going to happen to house prices. And it'll be really interesting to see, again, depending on all these different scenarios, there could be a number of scenarios where house prices actually soften and reduce a bit. And that could be the flip side where, buyers are helped in terms of getting on the housing ladder and buying their first properties. The other element to this is interest rates. So with everything we're going through, it seems very likely that interest rates will stay long for an extended period of time. And that tends to work its way through into the mortgage rates that people pay over the long term. So there's a number of different things at play here. In terms of will it be harder definitively to get a mortgage or not, I think it's too early to tell right now. We're still kind of in the very early stages of the pandemic, and we're also in the very early stages of seeing what the impact is going to be, both in terms of the housing market, but also in terms of banks' balance sheets and what they'll be willing to lend towards. What do you think, Peter?
I agree with you. It's almost impossible to actually know whether it's going to be harder. We see in the press a little bit about some of the mortgage lenders are increasing the amount of deposit that's needed. How long that's going to last for, we don't know. The one bit I was just going to add here, which has been quite an interesting one, because there have been a number of times in the office that when we've spoken about what interest rate, people have said to me, what interest rate are you paying? And I'm not going to say what that is, but the response has been, how have you been able to get an interest rate like that? And this is an odd bit with the market. Typically, if you go direct to supplier, you find that you get a cheaper product. That's generally with most things. The mortgage market is a bit of an odd one, because actually the cost of going to market for banks and building societies can be very expensive. So whether it be television advertising, stuff in the branches, etc. And what you often find in this market is that going via an advisor can actually get you a deal that is just not, in fact, very often you get deals through advisors, mortgage advisors, that you cannot get by going directly to the lender. And that's worth knowing, and it sounds a bit like a sell, and I do appreciate that, but it's not intended to, but it is fact. There are deals out there that are only available to advisors that aren't available to the public by going direct. Okay.
Yeah, I mean, there's another thing that just came to mind actually, which is there's a number of other things you can do to make sure that you've got all your ducks in a row. So, for example, making sure that your credit score is where it needs to be, ensuring that you've got everything you need in terms of your affordability checks. There's a number of other things you can do to make sure that everything kind of checks out, and the likelihood of you not getting a mortgage when the time is right is materially reduced. And we cover a lot of those actually in our app.
Awesome. Thanks very much, both. Lots of inside knowledge there. Love it. Cool. Another last home buying one, actually. And we might have touched on this previously, but this user says, should I buy a house immediately after lockdown or wait a few months or longer? So this is a first-time buyer. So, Peter, could you take on this one, please?
Yeah, I'll have a go.
Crystal ball.
I think the chap is crystal ball. I think that's the long and short of it. I mean, if it's a first-time buyer, then there is a potential benefit to be had if markets were to fall, because you're starting without a property needing to be sold. If I really don't know, is the long and short of it, and quite often advisors get asked these questions where the answer is we don't know. It might be sensible to wait a few months because you might get something a bit cheaper. I'm assuming that is the purpose of the question, but it might go the other way. It's very difficult. What I would say is what we always say about stocks and shares based investments is that they need to be seen as long term. Now, when it comes to buying your own home, is it an investment or is it just buying somewhere to live for the longer term? And the value of a property only becomes relevant at the points when you actually want to either move house or downsize or just sell and leave the country, for example. But so it's a tricky one. If it is not your first time and you are already in a home and you're thinking of moving from one place to another, then I think it's a bit more of a sort of you win on one hand, you lose on the other. As in, you might gain on the buying side, but you might lose on the selling side. So short answer is sorry, I don't know, but see it over the longer term is the way I would say it. Okay, Vivek?
Yeah, I mean, my view on this is I think post lockdown, whenever that may be, I think it will take time for things to get going again. When it comes to the housing market, things are really driven by again the fundamental drivers of supply and demand. And both of those things I think it will take some time for demand to come back, or demand to kind of start filtering through into viewings and going and visiting places, and for supply to come back as well. So I think it will be inevitable that people would have to wait unless they're already in a position to buy before lockdown happened. In which case, they should just make sure that they're very close to what's happening in the areas that they're looking at, and be ready to pounce if they see what they really want to buy. And I'd really echo what Peter said. Like, buying your first home really does go beyond looking at it as just an investment. It is a very emotional buy, right? You're going to end up living there. You're going to get so many hours of value from your first house purchase. So it goes beyond just trying to time it right. I think it is very much finding the right place as well.
Great. Thank you both very, very much. So we are running out of time now, so I think we'll make this the final two questions. So Anija asks, how much emergency savings do you recommend? So Vivek, what do you reckon?
Sorry, can you repeat that again, Annie?
Yeah.
I couldn't hear that properly.
How much emergency savings do you recommend?
Yeah, very, very good question. So we've slightly adjusted our recommendation here since the start of the pandemic to factor in the high levels of uncertainty. But we used to recommend 3 months of outgoings, and we've extended or 6 months for those who are self-employed, just to account for the kind of the uncertain nature of those who are self-employed. But now, given what we're seeing happen with this pandemic, we've now adjusted that to recommend 6 months worth of outgoings for everyone, whether you're employed or not. And that's just to increase the size of people's buffer to account for the high levels of uncertainty. I think, it's fair to say what we're going through right now, most of us have never experienced something like it. So it's very difficult to predict what is going to happen. And that isn't just in terms of people's balance sheets, people's kind of investment portfolios and the value of their homes or the value of their pensions, but this is also crucially something that's affecting people's cash flow. It's really affecting whether people have jobs, whether people have got money coming in month to month, and this is to that effect. We recommend going beyond 3 months and going for 6 months now, and we think that having that prudence and having that buffer will really help people get through this pandemic.
Awesome, thanks so much, Vivek. Peter, do you have anything to add on that one?
Only that if you were to ask 10 different advisors that question, they'd all come back with subtly different definitions of how they would do it, which really sets the marker that you have to be comfortable with the amount of emergency fund that you've got, and that there is no hard and fast rule. I think that would be how I'd close that.
Cool. And so, final question. And this is quite a broad one to end on, so I'm interested to hear what you both think of this. What do I do with my money now? Help us, Peter.
Brilliant.
Tell us the answer.
Yeah, I guess.
Oh, sorry.
Go
Peter first?
Yeah.
My answer to that is, and it sounds a bit corny, but we're all different. So therefore, I would be completing my information into the app and seeing what plan it generates me. And that's what I think I'll be doing. That's the short answer for me. Vivek?
Yeah, I mean, look, ultimately, this is why we built Multiply, right? Because we wanted to help people figure out what to do with their money. It's figuring this out is not easy. It's very complicated to do. There's so many different places you could put your money. There's so many different things you could do with it. And I think one of the most important things is to have a system to figure out where money should be going, and to make sure you've got all your bases covered before you start doing, I guess, the next activity. And we look at stuff in terms of, we call it a hierarchy. So that's just the way we look at answering where people's money should go is figuring out whether they've got like the foundational stuff right, such as paying off any debts or making sure they've got enough going towards their emergency fund, and then start looking at goals or life insurance and other things, or investing as you go up the hierarchy. But there's not just one thing to answer there. I think it's very much a case of figuring out where you are in that system. But having a system in the first place will really go a long way to helping you answer that and be confident about where you're putting your money and how much you're putting there and what types of products. And really, that's the fundamental reason why we exist. We're helping people to figure this out and to provide them with specific, personalized recommendations around what to do.
Awesome. Thank you so much, Vivek. Yeah. Great. Well, that's all we've got time for. We need to go and have some lunch now. But thank you everyone so much for tuning in, for joining, for sending in your questions. We've loved chatting and answering them all. And yeah, I guess we'll do this again soon because we've got more questions to go. So hopefully it was useful. And yeah, take care out there, everyone. Be well.
Thanks a lot.